Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer or to endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is August 13th. It's about a little after noon, and I just heard the president talking to the press in the background. Andy, so whatever we say, when we get off, the market could be totally opposite.
Yeah, good morning, Jim, and hello to all our audience again. It's nice to be doing this monthly podcast.
Yes.
And we have, as always, a lot to talk about.
Yes, we do. The market is kind of where it's same place it's been maybe a couple months ago, but it doesn't feel that way.
It definitely does not feel that way. It's been a wandering journey to get to $55, $56.
So, Andy, why don't we get right into this? The IEA's monthly oil market report came out on Friday, and they had a couple of interesting comments as usual, and I just want to throw them by you and get your thoughts. So they were saying that the first half of demand was up 0.6 million barrels a day, and they have estimates for the entire year at plus 1.1. Which would mean it's got to be a heck of a lot of growth going forward to make that estimate.
If you look at the individual pieces, the quarterly demand or the half-yearly demand, they're looking at a demand growth in the second half of 1.7, 1.8 million barrels a day. Jim, that is a really big number. And frankly, I don't see demand growing quite that robustly. I think they are way overshooting on demand, and apparently so is the market. I think the real number is going to be closer to a million 3, a million 4, something like that, or maybe even a million a day. They're big. What they see, and to a certain extent, they're right. Is there's going to be petrochemical demand increasing as a result of some of the new petrochemical plants globally. However, whether or not we see any growth on the petroleum product side, transport demand, and diesel. Well, we'll talk about diesel with IMO 2020, but certainly gasoline demand is flagging, and I'm not sure we're going to see that big of an increase in underlying petrochemical demand outside of the new plants.
Yeah, not to pick on these guys, but one other comment they had in there was the outlook is fragile, and the greater likelihood of there is a greater likelihood of a downward revision than an upward revision. And I'm just kind of wondering, why wouldn't you put your estimate where there's a 50-50 estimate?
Yeah, exactly. You would think you'd come out with a lower number anyway. And traditionally, I shouldn't say traditionally, but I think the market is definitely looking for them to revise demand downward for second half, which will in turn revise the downward the call on OPEC crude, et cetera. But it isn't as though the market has really been looking for dynamic growth all year. We've had these earlier in the year, yes, before the before the trade wars really worsened. Obviously, we made highs in the near $74 for Brent earlier the year, and then the trade war intensified, and the market sold off pretty broadly. But I agree with you, Jim. I think they should be coming out with lower numbers, and they will. I'm sure subsequently we are going to see lower demand numbers from the IEA.
Is it complicating the effort, the fact that many bought ahead of the sanctions? It was back in May. It seemed like people bought ahead of those and maybe are just working off inventories now or buying less after the sanctions. And is that possible? That's messing up the number.
I think it's definitely possible. We did see some surges from India and China. India is now slowed down based on their latest crude import numbers. But those crude import numbers probably do reflect some of not buying from Iran as they go look for alternative sources. And you look at OECD inventories, they grew by 50 million barrels in second quarter. I think third quarter will probably see inventories net draw. So Jim, your point is right on. I think there was some, I definitely think there was some, and certainly within some of how the roller coaster action in this market that may also reflect changing demand patterns.
So we have the news headlines of the trade war, and then the IMF downgraded their global GDP growth. They shaved it by a tenth of a percentage point. What do you see for world demand going forward now? You're saying?
I think as I said, I think second half for next year, for this year, for 2019 is not. I don't see 1.8. We downgraded our demand. We were around 1.1 and then 1, and now we're at 900,000 growth for 2019. We've seen there've been press reports of 650,000 barrels a day increase from one of the merchant. I think it was Trafi or Vitol. I'm not sure, but they were talking about 650 a day. I think that might be a little bit low because there is going to be new petrochemical demand. So we're sort of sticking with the 900. Now, what that does, we still think that in third quarter we're going to see a decent draw on global inventories. The call on OPEC crude, if you look at the three big, the big three, the IEA, OPEC, and the EIA, is like 30.8 million barrels a day. I think that's a little relative to an OPEC production number of, let's say 29.9 or 30. I think 30.8 is a little too high. I think it's going to come in at something like 30.5. But that's still, we should be drawing stocks now. And I think this rally, to a certain extent, the rally we're seeing today, I think if you see WTI down near 50, relative to where we are in the third quarter, that to me is too low. Looking ahead for the fourth, so I'm not. I think
50 basis WTI, right?
Basis WTI, yeah. I think 50 basis WTI doesn't really make sense given where we are in the quarter, and even in the fourth quarter, it looks as though we'll be balanced to maybe building a little, drawing a little bit. We'll see where the Saudis come out on their fourth quarter production. Having said all that, and talking about the demand, the IMF, the trade wars, where we are in demand, it's really, again, looking at WTI, it's really hard to make a case outside of geopolitical upsets that the market's going to get much beyond, the upper 50s to let's say 60, right? Which has been the high of the range. So, you look at a 50-60 number and, 50 low to 60 high, Jim,
Mm-hmm.
it makes sense.
Yes.
Given where the fundamentals are, it makes sense. What doesn't make sense, but I guess for you and me, having watched these markets for, 30 plus years, is the extreme violence that we've been moving between in this range.
Yeah. Just to confirm what you're saying, when we had that sharp down move in, what was it, August 7th, I think, earlier in the month,
Right.
we had a huge amount of volume trade in the option world and sharp down day. And what I found was interesting, once again, you had more puts than calls trade, but the call open interest was way above the put open interest in terms of increasing. So you can't, without interviewing every single person that's participating, you don't know for sure what's going on. But in general, it looked like people were using that decline to liquidate some put positions and put on some call positions. And to me, that looked a little bullish, which would go along with what you're saying, is that people don't expect the market to stay or get below, much more than where it had gone, below $50.
Yeah, given the fundamentals, they're not bad enough to really, to see the market really, get much below 50. It's not to say that it can't go there. We know that it can.
Anything can happen.
Right?
Well,
I mean, anything in this over 30 years, I think we've seen, everything is possible.
Andy, I also saw this is only a couple of thousand contracts but somebody bought a DEES 20 put for year 2020. So I don't know. The only thing I can think of is it's a market maker who maybe had done some producer hedges and ended up with a short put position, and they're looking to hedge it. I don't know. I hope, you think about what has to happen for oil to get down to 20. I don't know. I put that on our blog, and I just, the headline says optimist or pessimist. So I don't.
Yeah, to get down to 20. Well, yeah, if we go into a rip-roaring recession next year, negative growth, and all the markets start unraveling, and everything goes to one, right?
Yeah. Well, it's correlations. Yeah.
The correlations, just everything's correlated.
Germany's entire yield curve has gone negative, and I'm trying to think, would anybody ever pay me to go long volatility? I'm waiting for that. That's like negative vol, right? I don't know.
And that's not to say it can't get. I guess it can get down there if we do go into a horrible recession and U.S. production, really comes through it, in a very big way next year, and the sanctions are lifted from Iran, Venezuela comes back. I mean, there's a lot that could get it there.
Yeah, it's hard to see.
It's hard to see at this moment in time.
Always,
I think the range that we're in is explicable.
So, getting back to demand a little bit, the IEA talked about China up. This is just for the first half. China up 0.5, India up 0.1, US up 0.1. But
right.
The OECD is down for 3 consecutive quarters, and we keep hearing about peak demand. Have they found peak demand, or is that just
Jim? That's that's a really good point. I think it's certainly given where we are in the long term cycle. It certainly is possible. I mean, most of the growth again is going to be coming long term out of petrochemicals. I think gasoline demand. It's possible that's peaked in OECD. Diesel is another story because of the IMO 2020, and it's still used, for trucking. It will be used for shipping. I think the electric vehicle story is one that's going to develop later in mid 2020s, late 2020s. But in terms of OECD countries, I don't think gasoline demand is on a growth projection at all.
Yeah, we also have to think down the road of these restrictions in plastic bags, things like that, if that affects our petrochemical demand numbers going forward. I don't know when it reaches a critical mass. That could take also a little steam out of the demand growth. But again, let's get back to today and what's going on in the markets today. But do you want to talk? Where do you want to head next? You want to stay on demand and get into U.S. gas and U.S. Diesel demand?
Let's just talk about the U.S. for a little bit. Again, for the first half of the year, the demand has been completely unimpressive in terms of refined products, light products. Gasoline is going unchanged. Diesel's up a little bit, but so far less than forecast. We're seeing, again, petrochemical demand has been okay, but U.S. demand for the first half of the year was unchanged. And the EIA is forecasting similar to the IEA. The EIA, of course, is the U.S. government. The EIA is forecasting some really big numbers for the second half of of this year. I mean, surprisingly big number. Pretty big numbers. For instance, if you look at the monthly breakouts, they're saying that because of to a certain extent because of diesel, but just looking at December 19, they think there's going to be an 800,000 barrel a day increase in U.S. demand from year to year during the month of December. Similarly, in November, they think there's going to be a 400,000 barrel a day increase, and October 150. So fourth quarter, Jim, they're looking at numbers that, I just don't, after being unchanged for the first half, and we're going to be up 800,000 in December. I don't see that. I don't see that at all. And again, that's ethane is carrying the water there. It's petrochemical demand, they think. But that's going to be, don't you think that'll be 800 a day? That's going to be revised downwards. I just don't see that.
Yeah, they both, the IEA for 2020 is looking for an increase of 1.3, and I think the EIA is 1.4.
Right? That's globally. I'm just talking about U.S.
Yeah. So I was saying it.
I'm sorry. I should say that. I'm just talking about U.S. demand alone.
Right.
They're looking, our government is looking for an 800,000 barrel a day increase in the month of December versus December of 18. That's implausible. I mean, it's completely implausible. That's a big number, 800 a day.
Right. Yeah,
Yeah, it's not going to happen. So that'll be, that's going to be revised. That's sort of fictional. That'll be revised.
With the market, even though these numbers are coming out by these monthly reports, the market is not believing it either, right? They're more on what you're saying.
Right. I think if they believed it, the market would be closer to 60 and maybe probably above 60 if it really had a lot of faith that, that demand was going to be up 1.8 in the second half. I don't think they do. And so it's one of the reasons, it's definitely one of the reasons that the chief reason that despite the loss of Venezuela and Iran from global markets and the production cuts from OPEC plus, OPEC and non-OPEC, the market has, and the global geopolitical threat out of the Strait of Hormuz, the market has not gone, the market's not $10 or $15 higher.
Right. Well, do you have a good number on how much oil China is buying from Iran?
No, I don't, Jim. And I don't think, you have all these, one thing's unbelievable that has changed in just the last few years. There are all these shift trackers, right?
Right.
And even the shift trackers, they're coming out from 100 a day to, that Iran exports are 100 a day to Iran exports are 500 a day. I suspect China is buying from Iran. I have no idea what the number is, but I think they're probably hundreds of thousands of barrels a day.
That's a good answer. I mean, I've seen 100 to maybe up to 400,000 a day. So who knows?
Right. So, and I read something where somebody was saying that if China starts buying from Iran, the market's going to go down to, what was it, $30?
Yeah.
Like, wait a sec. How could that be? Because the most they've been buying from Iran was like 700 a day or 800 a day. So if they buy another 300, the market's going down $20. Come on. The answer to that is no.
Yeah.
I guess it could happen.
It's a good headline, though. I enjoy stuff. I enjoy reading.
I know you love stuff like that, right? And we all love stuff like that.
I think I was born long vowel. It's just in my nature.
We all love seeing that when somebody puts his neck on the line. What is he talking about? How could that be? And then maybe they're right. Sometimes they're even right.
Yes.
But I don't think the 300 or 400 a day is going to make that big of a difference. So
let's talk about distillates.
Okay, let's talk about distillates because
we didn't mention we have this Philadelphia refinery shut down, and yet we still have no problem making distillate supply. I mean, it's probably they're making gasoline more than anything, but
yeah, both like products, and this is a real problem. That could be a real problem here in the U.S. because we just went up. Runs finally. How many months this year, Jim, have we been talking about when are refiners going to get their act together?
Right.
And they finally did. They even with Philly out, they produced 17.77 million barrels a day, which is a pretty high. I don't know if it's a record or not. I didn't check, but it's got to be close.
So that's over 1 million where it was, right?
Right. I mean, we went up at like 800,000 last week. So, I think those numbers are going to be pretty strong here over the next few weeks before we go into turnaround. So, what does that mean? It means we're going to make a lot of light products. We're going to make the diesel. What was it? June or July was the highest.
July. Yeah, July. They have record production of distillates, and then highest yield as well, 29.6 is record for July.
Yeah,
it's getting to wintertime levels.
Right, and this is going to continue through August and into September. So right now, diesel is in pretty good shape. It's okay. The inventories are 137 million barrels. The 4-year average is 144 million. Day supply right now are 35.3 versus 36.7. So it's okay, but there's danger there. There's definitely danger that we make too much. Like that globally we make too much, anticipating this huge increase in demand for lighter sulfur fuel for the the change in shipping specs. And so that's something that, obviously we're all going to watch pretty carefully. Diesel stocks have just increased by 8 million barrels in the last few weeks. So, diesel, and it wouldn't be the first time in our long and somewhat storied careers, Mr. Colburn, that refiners have messed up on making too much in anticipation of a demand surge.
Yeah. You don't want, there's no gasoline distillate spread play that works seasonally, right?
No.
Another way to say that. What's interesting to me, sorry.
Go ahead.
I was going to move away from distillate.
Okay.
In the last couple of days, there's been huge volumes in spread options, and particularly the OC Novi, Novi Dis, and Dis Jan plus 50-cent call. There's been 10 to 15,000 on each one of those strikes. And yes, every buyer has a seller, but let's just say that it was initiated by the buyer. What do you think that play is about? And let's say it's a speculative play.
Yeah, it has to definitely do with some of the new pipeline capacity that's coming on board out of the Permian Basin into Houston. The Cactus II pipeline just started, and that's like I think it's 800 a day, and apparently one of the shippers just put in 300,000 a day. So I think that's what, the and I don't know why, we know this capacity is coming, but we're also seeing the differentials move pretty good. We're seeing the Permian crude is now trading at a premium to WTI, and you all remember that was at light Permian is trading at a premium now. You all remember that was at a big discount, and Houston has gotten cheap relative to Cushing. So if the marginal barrel is not going to go to Cushing from the Permian and moves to Houston, obviously that should be supportive for the front of the curve.
Yeah, so that those spreads are trading, let's say average around 34 cents, and it's a plus 50 call. So there's, it's not, and it has moved up. I mean, that spread has moved up. I assume it moved up with the refinery runs moving higher as well.
Right, and refinery runs.
But you don't see, like, if you look at say a DEIS 19, DEIS 20 spread, or a Jan 20, Jan 21 spread, you're closer to 20 cents a month. So it's not, hasn't, next year doesn't seem to have any, it's kind of hasn't moved in. I don't know, maybe it has, but it doesn't seem like it's there yet as far as looking at a major structural.
Well, you're going to get, production is expected to grow.
Right.
And I think that's why you can't get, the back hasn't gotten that exciting. But, what has been exciting is that even though we just dropped like 50 million barrels on inventories, on crude inventories, the curve got whacked, which it should, you're like, oh, right. Man, I can't believe, how is the curve getting whacked, getting weak when, we're drawing this much crude? It should be the opposite, but obviously it had already anticipated some of these draws, I guess.
Yeah, it's been waiting for a while, but yeah. Just to quickly move over to U.S. Oil production, looks like the EIA is ratcheting down. This is where the growth is not as intense as it was. So basically they're saying we've been growing, expect to grow 50,000 barrels a month going forward, and it had been 100,000 from, say, August of 18 to July of 19. Right. So,
yeah, I mean, they've definitely revised downward their production expects, I think, based on some of the really downbeat stuff that's coming out of the producers on, some of these father-child wells have not been coming, aren't producing quite as much as what some of these producers had expected. And, they're not, they've been, a lot of the big independent producers have been more and more downbeat. So I think the EIA is taking a cue from them. However, even with that, right now we're producing 12.3 million barrels a day, I think, on the last weekly. So they're looking at next May and June, they say, is going to be 13.2. So they're still saying that within a year we're going to be up 900,000 barrels a day.
Yeah. Their year-on-year estimate is plus a million.
Yeah, okay.
So they're looking for 12.3 for 2019, 13.3 for 2020. So yeah, they're still up a million.
Right.
Yeah.
Right. So 1 million barrels a day, we know runs aren't going to go up, aren't going to go up all that, can't go up all that much because we're not building, we're building some added capacity, but nothing like that.
Right.
Imports will go down and exports have to go up. So, next year should be pretty interesting, to see whether or not we're going to make that, make those big increases, and B, whether there's enough export capacity to handle it, to handle getting rid of some of that.
Andy, it looks like if I take your chat overall, it looks like you're still, despite all the craziness, you're looking at a market that's relatively in balance. It's not going to collapse, say, below. Listen, we said anything can happen, but maybe below 50, and you're not too excited about it getting above 60. Could I say? Am I saying that right?
Again, the Saudis, their sweet spot. What they'd love is they've revived the IPO for Aramco, so they would love to see Brent with a 7 handle, and they would. They were so happy, I'm sure, earlier in the year when Brent was trading 74, and then they got undermined by Trump, China, and so some the general slowdown. But they'd have to cut production severely, I think, to get this up, to get WTI up to 65 to 70, and doesn't look like they're going to do that. They are going to cut production. It's unclear as to what the number is yet.
They are under their agreements by by a bunch, right? 700,000 or so.
Yeah, by a lot.
By a lot, yeah.
They're saying they're going to get exports under 7 million barrels a day. So I'm thinking it's another 300,000 or 400,000 barrels a day cut, which will help. I mean, it'll help keep that. That's why it's, that should help. And we'll see where the other OPEC producers come in, and what Russia, the Russians just, they lost a lot of production when their pipeline to Europe was contaminated. So we'll see where they, will they come out at. Jim, it's I think 50-60 is, looks right.
So the
basis WTI. The other thing that we just one thing that, getting back to differentials, the Brent TI has collapsed. Not collapsed, it's really rallied. With the anticipation that Cushing, that it's been more on the WTI side, but Brent too, because there has been an overhang in Nigerian crude, which I think will clear up pretty quickly. It's pressured the front end of the Brent market, and we've seen a big rally on Brent TIs. I think that's going to weaken. Actually, I think WTI is going to weaken relative to Brent. As we get some more production cuts in Nigeria, and Nigerian light clears up, but we'll see.
Something to watch. One more thing in the options world, continues the high for volatility. The high was when we came into this year, January 2nd, around 53%. The low was in April, down to around 22%. And Friday's settlement was 32.2. I think we closed maybe a little bit below that yesterday. And the historical volatility is up around 40. So we're trading the implied is below historical. That happens. It's it means the market's moving around more than what the option traders are thinking it's going to do forward. Going forward. So we'll see if this market comes down a little bit or not. But it has been, again, it's one of those markets where you look back and you're in the same place you were a few months ago, but you've been on this. What's the Coney Island roller coaster?
Yeah, you've been on the
Thunderbolt, something like that.
Whatever it is, you've been on one of these crazy roller coasters.
Yeah. So, anything else you want to say before we wrap it up?
Nope. I want to, I guess, again, if you want to get a hold of either one of us, hit me up at Lebow at commodityresearchgroup.com and Jay Colburn at commodityresearchgroup.com. Our website is www.commodityresearchgroup.com. And Jim, as always, it's been a pleasure talking to you.
Sounds good, Andy. I'll talk to you next month.